Welcome back to The Explainer. Today, we're diving into our financial source material to tackle the absolute core dilemma of investing. It's the ultimate balancing act, right? Risk versus return. Look, every single time you put a dollar into the market, you're making a fundamental trade-off. You're basically accepting a certain amount of uncertainty and just hoping to get a specific reward out of it. But how do you actually measure that uncertainty? How do you know what your expected return should genuinely be? Well, to figure that out, we rely on two of the most critical concepts in modern portfolio theory, the capital market line, or CML, and the security market line, the SML.
So ask yourself this: are you actually getting paid for the risks in your portfolio? It's a pretty provocative question, but it perfectly frames the danger of just investing blindly. If you're out there buying up stocks or mutual funds without accurately measuring the specific type of risk you're taking on, you are literally flying blind. You could be stomaching massive amounts of volatility without any solid mathematical justification for the returns you're expecting. Today, we're going to fix that by unpacking the precise tools you need to measure and price that risk.
Okay, let's dive into this. Here is our roadmap. First, the risk-return reality. Then, total risk with the CML, systematic risk with the SML, a tech versus FMCG showdown, the ultimate comparison, and finally, your asset allocation.
Part 1. The risk-return reality, the absolute foundation of portfolio management.
Here's the thing. Both the capital market line and the security market line share the exact same goal. They both want to chart the mathematical relationship between the risk you take and the expected returns you should demand based on the capital asset pricing model, or CAP. But despite having the same goal, they cause massive confusion. For finance students and everyday investors alike, it's a huge stumbling block, and honestly, it makes sense why. On a graph, they both just look like straight lines sloping upwards, and they both deal with that risk-return trade-off. But here is the catch. If you substitute one for the other in your analysis, your investment models will be completely broken. So we've got to break them down systematically, starting with the macro view.
Moving to Part 2, CML, total risk, the wide lens on portfolios.
When we talk about the CML, I want you to think big picture. It maps out a path starting all the way from the risk-free rate, so think of a super safe government bond, and it perfectly touches the efficient frontier at the tangency portfolio, which basically represents the overall market. To do this, it uses total risk, which mathematically is just standard deviation. This captures the complete volatility of an efficient portfolio. We're talking every single up and down swing. And the underlying logic here is actually beautiful. Because we're assuming the portfolio is fully diversified, all that random company-specific noise, it's been completely neutralized. So total risk, standard deviation, is literally the only risk metric that matters when you're evaluating the portfolio as a whole. Let's break down the mechanics of the CML graph itself. Across the bottom, on the x-axis, you've got that total risk, the standard deviation. Up the side, on the y-axis, you have your expected return. Now, the slope of this line is absolutely crucial. It's the Sharpe ratio, which measures your risk-adjusted return. If a portfolio sits perfectly on the CML, boom, it's efficiently priced. It's giving you the best possible return for that specific level of total risk. But if your portfolio sits below the CML, it's inefficient. You are taking on way too much volatility for way too little reward. And theoretically, under CAPM anyway, portfolios above the CML simply shouldn't exist, though, every hedge fund manager on Wall Street will swear otherwise.
And this brilliantly illustrates exactly how this works in practice, especially when you're looking at mutual funds. Check out this comparison. You've got Fund A and Fund B, and they both offer a 12% return. Great, right? But wait. Fund A gets that 12% with a standard deviation of 10%, while Fund B is swinging wildly all over the place with a 15% standard deviation. Using the logic of the CML, professional managers are going to pick Fund A every single time. It sits closer to the CML because it delivers the exact same return, but with significantly less total risk. That right there is the Sharpe ratio in action, maximizing your risk-adjusted performance.
Part 3, SML, systematic risk. Now we're zooming in on individual stocks.
Now, that CML model we just talked about, it completely fails if you try to use it for a single stock like Apple or Tesla. Why? Because individual stocks are full of unsystematic risk. Think about a chaotic CEO scandal dropping out of nowhere, or a sudden massive supply chain failure. The market is not going to pay you for a risk that you could have easily avoided just by diversifying and holding more stocks. That's exactly where the SML steps in. It uses systematic risk, which you probably know as beta. Systematic risk is that built-in, unavoidable risk of the entire market. It's inflation, it's interest rate hikes, macroeconomic shifts, the whole shebang. Beta measures how sensitive a specific security is to those broad market movements. Under the CAPM equation, beta is literally the only risk you actually get rewarded for.
So, what do these beta numbers actually mean in the real world for a security? Well, a beta of exactly 1.0 means the stock moves in perfect lockstep with the overall market. Market goes up 10%, your stock goes up 10%. Easy. A beta of 0.5? That indicates low market sensitivity. It's a defensive, much less volatile play. But a beta of 1.5? Okay, now we're talking about a highly aggressive stock. If the market jumps, this stock goes straight to the moon. But if the market tanks, this stock is going to crash significantly harder.
Which brings us to this fundamental quote, really the core rule of the security market line. Higher beta leads to higher expected return. It is a direct, linear relationship. If you're going to willingly put your hard-earned capital into an aggressive stock that is highly sensitive to market crashes, the math of the SML says you absolutely must require a proportionately higher expected return. You have to be compensated for that extra anxiety.
Part 4. Tech versus FMCG. Let's see beta in action.
Okay, abstract theory is great, but let's talk about the brands you interact with every single day. Let's contrast aggressive tech stocks with defensive, fast-moving consumer goods, or FMCG stocks. High beta tech names, your Teslas, Nvidias, and Metas, are hypersensitive to market swings. Back in the crazy bull market of 2021, they rose incredibly fast and delivered massive returns. But when interest rates hiked in 2022, those high beta stocks crashed hard. Investors demanded higher risk premiums for the pain of holding them through that turbulence. On the flip side, look at low beta FMCG stocks like Hindustan Unilever or Nestle. Look, people are still going to buy soap and coffee even during a recession, right? Because of that, these stocks fall much less during market crashes. They offer lower systematic risk, but the trade-off is that the SML dictates they offer lower, more stable expected returns.
Part 5. The showdown, the ultimate comparison.
Now, what's really interesting about this slide is that it prevents the single most common mistake people make on the CFA Level 1 exam, a mistake that can seriously damage a real-world portfolio, confusing standard deviation and beta. Let's draw the battle lines very clearly here. For the capital market line, the risk measure is always total risk standard deviation, and it only applies to fully diversified, efficient portfolios. For the security market line, the risk measure is systematic risk, beta, and you can apply that to literally anything, individual securities, entire portfolios, you name it. The x-axis on your graph changes completely depending on what exactly you're trying to value.
You also have to interpret deviations from these lines entirely differently. We already know that a portfolio sitting below the CML is inefficient. It's just a bad deal for the investor. But what about the SML? Well, if an individual stock happens to plot above the security market line, that is an incredible find. It means the stock is actually undervalued. It's offering you a higher expected return than the CAPM model says is strictly required for its level of systematic risk. Honestly, finding assets above the SML is essentially the holy grail of stock picking.
Finally, Part 6. Asset allocation. Putting all this theory into practice. So, the crucial point is how you actually deploy these concepts for your own wallet. It's time to connect the math to your money. First, you have to match the right risk measure to the right asset. When you're looking at your overall 401k or evaluating a mutual fund manager, use the logic of the CML. Look at their standard deviation and calculate that Sharpe ratio to make sure they're actually being efficient. But when you want to buy an individual slice of a company, like maybe a hot new tech stock, use the logic of the SML. Find its beta, plug it into CAPM, and figure out its required return. And above all else, please ensure you actually diversify your holdings. The market is simply not going to reward you for unsystematic risk that you were just too lazy to diversify away. These tools really do form the absolute backbone of modern portfolio optimization.
If you take away only one lesson from our source material today, let it be this unifying principle. Ensure you are compensated appropriately for the exact type of risk you bear. Risk isn't just some vague feeling of anxiety in the pit of your stomach. It's a measurable, mathematical input that dictates what your future wealth should be. Whether it's total portfolio volatility or systematic market sensitivity, you've got to price it accurately.
Which brings us to our final thought for today. Open up your brokerage account right now. Take a hard look at your biggest holdings. Are the returns you're desperately chasing actually mathematically justified by the beta and standard deviation you're absorbing, or are you just crossing your fingers and taking on a bunch of uncompensated risk? Dive into those numbers, guys. Thanks for joining me for this explainer, and keep questioning the data.